Welcome to the Stock Market Palantir channel. Don't miss any new stock insights from us by hitting the subscribe button, and feel free to leave your comments. All right, let's check the analysis.
Okay, Friday, January 30th, 2026. The closing bell has rung and PepsiCo, ticker PEP, is settling at 148.76. Now that's a fractional gain plus 0.05% on the session, so effectively flat, right? But looking at that raw closing number, it completely ignores the violence of the intraday action we just saw. I mean, we saw a range from a low of 148.44 all the way up to 150.86. That is pushing right up against the teeth of that really formidable resistance zone at 152. And, we're seeing volume dynamics that suggest real institutional accumulation. Specifically, I'm looking at that 7.11 million share print we saw earlier in the week on the 27th as we recovered from the 144 lows. From where I sit, looking at the charts, this isn't just noise. This is a high-conviction consolidation, and it's resolving upward. We have a clear breakout from an inverse head and shoulders pattern at the 148 level. The structure is, well, it's unmistakably bullish.
See, I just come at it from a completely different way. You're looking at the breakout, I'm looking at the exhaustion. You simply cannot ignore the oscillators here. I mean, we are staring at a 14-day relative strength index, the RSI, of 77.87. That is well above the traditional 70 threshold for overbought. We're also seeing a Williams percent R of negative 4.726. And for those listening who don't watch that specific indicator, anything closer to zero than, say, negative 20 is just screaming that the stock is overextended. Statistically, this equity is overheated. It's deviated significantly from its mean in a very, very short window. So while you see a breakout, I see a stock that is just technically stretched and sprinting toward a brick wall of resistance at 152 without the oxygen to scale it.
I see why you'd think that. I do, particularly if you're just trading purely off mean reversion. But I think you're mistaking momentum for exhaustion. This isn't just a technical move. The thesis here is that PepsiCo is resolving into a structural bull market. It's driven by a triple threat that the market is, I think, finally waking up to. You've got deep value, reliable yield, and a massive AI-led efficiency transformation that changes the margin profile entirely.
And that right there is where I have to push back. I am not convinced by the tech transformation narrative, because at the end of the day, this is an asset-heavy business. While the floor is solid, I'll grant you that, the stock is structurally inefficient compared to its peers. You have rising short interest heading into the February earnings, and you have a valuation that, while it looks optically cheap, exists for a reason. PepsiCo's owning trucks and factories while its competitors are collecting royalty checks. That's the trap.
Well, let's dismantle that dinosaur argument right now, because frankly, it's outdated. The biggest news catalyst for 2026, which I believe is currently mispriced, was the announcement from CES on January 6th. This isn't just a beverage company anymore, it's a technology-driven logistics play. They announced a multi-year collaboration with NVIDIA and Siemens to deploy digital twins.
Digital twins is a fantastic buzzword. I agree. It plays very well in a press release and it gets the algorithms all excited, but does it actually move the needle on a balance sheet with this much weight?
It absolutely does. And we need to be precise about why. This isn't just, 3D modeling for fun. They are using the NVIDIA Omniverse and Siemens Digital Twin Composer to simulate every single machine, every conveyor belt, every operator path in their U.S. manufacturing facilities before they even physically install them. The pilot programs are already showing a 20% increase in throughput, but more importantly for the bottom line, they are projecting a 10 to 15% reduction in CapEx, capital expenditures.
Okay, but explain how a simulation cuts the capital spend.
Because they are finding hidden capacity in their existing footprint. By running millions of AI simulations, they realize they can tweak the existing lines to produce more, which means they don't have to build new factories to meet demand. They just run the existing ones with AI-perfected efficiency. That fundamentally changes the return on invested capital calculation. It stops the bleeding of cash into new concrete and steel. It justifies a move toward that algorithmic price target of 178.
That is a compelling narrative, I admit, and I don't doubt the technology works. But as an investor, I have to look at the cost of carrying those assets in the first place, optimized or not. I mean, even if you optimize a factory, you still own the factory. You still pay for the maintenance, the depreciation, the labor. Compare this to Coca-Cola. Coca-Cola is trading at a premium because it is asset light. They sell concentrate to bottlers. PepsiCo makes the chips, drives the trucks, stocks the shelves.
But you're paying a massive premium for that difference, and that's exactly my point.
A justified premium. Look up the return on invested capital, the ROIC. Coke is trending near 20% because of that superior efficiency. PepsiCo lags behind exactly because of that capital intensity. You're talking about a 10% reduction in CapEx, which is good, I admit that. But it doesn't close the structural gap between a logistics-heavy business and an intellectual property business. And the market knows this. That's why we see this sort of magnet effect around the volume-weighted average price, the VWAP of 152.10. Every time the price rallies to that level, institutions sell into it because the math says the multiple is capped.
But that structural gap is exactly where the opportunity lies. The market is pricing PepsiCo at a massive discount because of that historic view, and it's ignoring the change. Look at the valuations. PepsiCo is trading at a forward PE of 16.97. Coca-Cola is up at 24.19. That is a massive spread, almost 8 turns on the multiple. And for what? PepsiCo has nearly double the revenue, $97 billion projected versus Coke's $51 billion.
Revenue is vanity, profit is sanity. Coke keeps more of every dollar.
But the efficiency is there. Look at the return on equity. Pepsi's generating an ROE of 38.53%. Compare that to Keurig Dr. Pepper at 6.38%. Management is incredibly efficient at generating returns for shareholders, and you're getting that at a 16 times multiple. You are buying $1 of earnings for significantly less than you pay for Coke, and you're getting a management team that is squeezing nearly 40% returns out of shareholder equity. That is not a trap, that is a bargain.
The discount exists for a reason, though. It's the margins. Pepsi's net margin is sitting at 15.37%. Coke's margins are significantly higher because they don't have the operational drag. The market pays a premium for net margin, not just raw revenue. And when you have lower margins, you have less room for error when inflation hits or input costs rise. And technically right now, the price is validating my caution. Every time we get near 152, the market asks, is this as good as it gets given the margin profile?
I'm just not convinced by that line of reasoning because it ignores the safety net. You're getting a dividend king, 53 consecutive years of increases. The yield right now is sitting somewhere between 3.8 and 4.1%. In a macro environment that is still uncertain, where rates might stay higher for longer, that yield provides a floor that growth stocks just don't offer. And frankly, the growth isn't absent, it's just coming from different places.
Well, let's talk about those places. Because if the core business is mature, soda and chips are not exactly hyper-growth categories. Where is the alpha coming from? You can't just squeeze a factory forever. You need top-line growth.
It's the business relations portfolio. This is the hidden engine that the street is underappreciating. Take Celsius Holdings, CELH. Pepsi owns an 11% stake in them. Celsius is growing at 31% annually. They are the strategic energy captain for Pepsi. And it's not just Celsius. They've transitioned Alani Nu into their direct store distribution network as of December of 2025. That is going to broaden their reach significantly in the first half of this year.
Distribution deals are nice, but are they game changers?
They are when you control the shelf. Then look at the Starbucks partnership. The North American Coffee Partnership revenue is up 20%. They are innovating with specific products, driving volume, like the iced Dubai chocolate mochas.
I'm sorry, but I just don't buy that niche products like Dubai chocolate mochas are moving a $210 billion market cap elephant. And regarding the partnerships, you have to look at the failures too. Look at the Planet partnership with Beyond Meat. The plant-based category has faced massive headwinds. Pepsi has exposure there. Is an 11% stake in an energy drink company really enough to offset the capital intensity of Frito-Lay and, the stagnation in traditional carbonated soft drinks?
It doesn't have to offset it entirely. It just has to provide the growth kicker on top of the value, and the energy sector is doing exactly that. Celsius is far outpacing the traditional category.
Pepsi is leveraging its distribution network, which you call a liability, to monopolize the shelf space for these high-growth brands. They own the truck, so they decide what goes on the shelf. That is the power of the asset-heavy model. It's a moat. You can't digitally download a bag of Doritos. You need a truck. Pepsi owns the trucks.
We can debate the strategy, but we can't ignore the plumbing of the market. There are warning signs flashing in the market microstructure that worry me. Look at the short interest. It's rising. As of January 15th, we are up to 21.7 million shares sold short. That's about 1.64% of the float. Now, historically, that's not a squeeze level, but the trend is upward. It's creeping up from the October lows. To me, that suggests smart money is hedging. They're betting on a potential earnings miss, or at least a guide down in February.
I interpret that data completely differently. You have to look deeper into the dark pool analysis.
Dark pools are opaque by design. Relying on them is tricky.
But the data leaves footprints. Nearly half of the volume, 49.75%, is happening off exchange. Now, for our listeners who might not watch the tape all day, this is a really important concept to grasp. When you see high net short volume in dark pools, it's counterintuitive. It doesn't always mean bearish betting. In the dark pool context, market makers often short stock to facilitate buy orders from institutions.
Okay, explain that mechanism, because on the surface, selling short sounds like a bet against the company.
Right. So think of a market maker as a wholesaler or a middleman. A large institution, let's say a pension fund, comes in and wants to buy a massive block of Pepsi. The market maker doesn't have the shares on hand right that second in their inventory, so they short the stock, essentially selling a promise to deliver to fill that institution's buy order immediately. Then, the market maker goes into the open market to buy the shares to cover their position. So that high short volume you see in the dark pool print, that is actually a receipt of a massive institutional buy order. They are accumulating shares without wanting to spike the price on the lit exchanges. It is a bullish signal of institutional loading.
That is a generous interpretation. It relies on the assumption that the market maker is facilitating a buy, not initiating a position of their own.
But it's supported by the insider activity. Contrast the CEO's sale at 155 way back in 2025 with what is happening now. We have seen a cluster of buying from the board of directors in the 143 to 149 range. Ian Cook, Dave Lewis, Susan Diamond, they are all buying. This sets a value floor. When the board is buying with their own money at these levels, they are signaling that they see the stock as undervalued. And they know the books better than we do.
Insider buying is a positive signal. I'll grant you that. Executives buying with their own cash is rarely a bad sign. But let's talk about a different kind of signal. We're seeing a new era of analysis emerging with prediction markets.
Exactly. This is the polymarket correlation. And frankly, it's validating the bull case. We have the Dow Jones partnership with Polymarket now. You have the IC investment of $2 billion validating the platform. This isn't just internet gambling anymore. If you look at the specific contracts relevant to Pepsi, they are bullish.
I'm skeptical about basing an investment thesis on betting markets. I mean, the crowd can be wrong. It's sentiment, not fundamentals.
The crowd can be wrong, but the money is usually right. Look at the tariff markets. This is crucial for a global company like Pepsi. Polymarket traders are betting heavily no on new tariffs for coffee and agricultural imports. That is a direct input cost reduction for Pepsi. If those tariffs don't materialize, Pepsi's margins expand automatically. And look at the earnings expectations. The prediction markets are signaling a bullish outcome for the February 3rd report. The stock's rise from 144 tracks almost perfectly with the shift in sentiment on those contracts.
I acknowledge the correlation, and it's an interesting data point. But I have to warn you, prediction markets are often lagging indicators of sentiment rather than leading indicators of fundamentals. They reflect what people hope will happen or what the news cycle is saying today. And fundamentally, or rather technically, we are back to my original point. The Williams %R is at -4.7, the RSI is near 78. Even if the prediction market is bullish, the stock is mechanically overbought. You are buying at the absolute top of the short-term range.
And I would argue that in a breakout scenario, overbought can persist for much longer than oversold. The ADX, the average directional index, is at 45.71. That measures the strength of the trend, not the direction. And a 45 reading suggests this is a strong trend, not a temporary spike.
The moving averages are all below us providing support. The 50-day SMA is at 147.29. As long as we hold that, the path of least resistance is up.
But that gap between the current price and the 50-day SMA is exactly the risk. We are extended. If we get even a slight miss on earnings, or even just a sell the news event, we could easily retrace back to that 147 level. Why buy now at 148.76 when the rubber band is stretched this tight?
Let's bring this into focus then. We have a stock that has been dead money for a while, suddenly waking up with a technological catalyst, strong insider buying, and a valuation that is compelling compared to its main rival. The yield pays you to wait. You're getting paid 4% to wait for the market to realize that Pepsi is an AI efficiency play.
And we have a stock that is hitting a historic resistance wall at 152 with momentum indicators screaming pullback, and a business model that is capital intensive in a high-rate world. You can't just ignore the macro or the math.
So how do we close this out?
I'll summarize my view like this. PepsiCo is a solid defensive hold, no question. If you've held it for 20 years, you keep holding. But right now, today, it is a dangerous entry point. With the RSI near 78 and that magnet resistance at 152, the risk-reward is skewed to the downside in the short term. The operational complexity, factories versus concentrate, it limits the multiple expansion. You aren't going to get a Coke multiple on a Pepsi business. My move? Wait. Let it pull back to the 50-day SMA around 147.29. Let the steam off. Don't chase the green candle.
I see the caution, but I think you're missing the transformation. The AI and digital twin pivot is real, and it's going to close that margin gap with Coke, which means the multiple has room to expand. We have a triple threat here: high yield, growth via Celsius, and tech-enabled efficiency. The insider buying sets the floor. The breakout from the inverse head and shoulders is technically valid, and it targets 178. Current levels are a buy for the long-term investor who wants to front-run the efficiency gains before the rest of the street prices them in.
Well, we can agree on one thing. The February 3rd earnings are going to be the judge.
Absolutely. And whether or not we break that 152 resistance wall will tell us if this is a trade or a real trend.
Until then, watch the volume and watch that RSI.
And keep an eye on the dark pools. That's where the real story is being written.
Thank you for watching the video. Remember to subscribe to the Stock Market Palantir channel for more stock analysis like this, and leave your comments below. See ya.